trading between an upper range and a lower range, which will not give any clear market direction. And sideways markets, usually traders try to avoid, because 80% of the traders in the market, they look for market direction, they look for breakout trading. Unfortunately, 80% of the traders in the markets are breakout traders, momentum traders. They chase momentum, they chase the price action. That is what traders do in the markets. But the problem being the market does sideways 80% of the time. I mean, theoretically not 80% of the time. I would say like at least 70 to 75% of the time, the markets get into a compressed mode. Sometimes very seasonally, the market trends. And moreover, not every breakout is a successful breakout. There are many at times, it even ends in a breakout failure also, right? So breakout trading is pretty challenging. And sideways markets are very frequent. Sideways market, choppy markets are very frequent. That is what it makes trading very difficult. So somewhere we have to learn to understand the sideways markets, and somewhere we have to learn to observe the sideways markets very closer. So that is what we're going to do in today's session here. So let's try to get some characteristic of a sideways markets. So of course, sideways markets means lack of clear trend. Price will be trading between upper range and lower range. Some people even say like price will be trading between support and resistance. And usually sideways markets happens, if you see the intraday price dynamics, the sideways markets mostly happens because of low volume activity, lack of participation, lack of enthusiasm from the traders, maybe the lack of catalyst, some news flow might be missing, or maybe a major news flow is likely to happen. Maybe let's say tomorrow could be an RBI policy announcement, or maybe tomorrow could be a Fed announcement. Market is having a lot of expectation, nervousness. So ahead of the event, markets get into a quiet mode sometimes, because big traders, they will always love to play after the event most of the times. Not every time traders love to position themselves ahead of the event. Let's say the recent event nearing is the election results. So many at times what the institutions do, they will get into a hedging mode. They will stay away from participating in such kind of markets, right? Before any major event is likely to happen. So that time we'll be seeing a low volume activity, lack of interest from the market participants. And what usually happens is like the horizontal price range bound development will happen around the VWAP levels. Price will be keep on trading around the VWAP levels. That you can see it very often from an intraday perspective. So here the sideways markets, I'm not going to talk from an daily chart, or I'm not going to talk from an hourly chart perspective. I'm going to talk from an intraday perspective, most likely from a 5-minute time frame, how we can identify whether today's markets will get into a sideways market or not. Right? That is a whole idea behind that. So here is an example of a sideways market. This is from 2nd May. Of course, this is a Bank Nifty chart. You can see the horizontal development which is happening. There is no theoretical rule says like a market will be trading between the supports and resistance. In fact, from intraday perspective, there is nothing called support and resistance. The horizontal development over here, you can see that majority of the time price moves in a rectangular format. Yeah, sometimes you might be able to see price going outside extremes also. Price goes sometimes outside the value area and it rotates back again to the center point. Typically, if you see any day's price action from a volume perspective, the opening volume will be mostly on the higher side. If you could see that, this is the opening of the day. So this is the opening of the day. Here the price is actually opening. Oops, just give me a sec. So here is the opening of the day. Price opens over here. When the price is opening, you can see that usually the volumes will be relatively high. Volumes will be relatively high around the open. So most like the volumes will be relatively high during 9 o'clock till sometimes it can go up to 10 o'clock also. So 9 o'clock to 9 to 10, usually the volumes will be very high. And after that, you can see that volume get into a quiet mode. You can see the volumes are getting quiet over here, and some big volumes are shooting up over here. This block, some big volumes are getting transacted, and after that, you can see that mid of the day, particularly, the liquidity in the markets dries up. That means volumes will be getting more and thin and thin and thin and thin. You can see this up to till major part of the day. You can see this kind of price action. So first thing to recognize is like, is the volumes are slowing down, right? So probably how do I know whether the volumes are slowing down? One way you can identify is like, is the volume is suddenly dropping from the normal volumes. Maybe I'll show you how you can identify whether the volumes are dropping down or not in real time. And at the end, again, volume shoots up. So again, around the market closing, maybe sometimes the volume shoots up. Here, the volumes are not substantial, but usually after 3 o'clock, lot of institutional volume happens sometimes, because there is a saying that dumb money trades at the first and smart money trade at the last. Though that is not necessarily true. I mean, that is not necessarily true, but to some extent, institutions love to trade around the market closings. Not every institutions, but some institutions, they love to trade around the closings. Institutions can even, they can come around the opening also. So recently there was an RBI issued a ban on the Kotak Bank, right? So almost 10 million plus volumes got traded around the opening itself. A huge volume block traded around that time. Almost 10 million shares got transacted. That means some huge institutional participation would have been happened, right? So at the opening of the bar itself, 10 million volumes has been happened when the RBI banned the Kotak. You just go back and check the Kotak charts, you'll get to have a fair idea of what kind of volume got traded around the open. See, one thing is very common, sideways markets are very much associated with the low volume activity. But inside that, can we see any meaningful pattern out of it? So that is what the primary discussion here. Let me try to pull up. So why this sideways market typically happens? Sometimes there will be market indecisions. Buyers and sellers will be fighting against each other to establish a clear direction. Buyers will be fighting for an uptrend, sellers will be fighting for a downtrend. So a lot of fight will be happening among them, and nobody is winning the war. So a lot of indecisions happens around that level. And sometimes there'll be a supply-demand equilibrium, and sometimes low trading interest. There'll be lack of participation from the markets, usually contributes to a sideways markets. So a lot of momentum traders will be missing in the markets. The dominant traders, the trader who have the muscle power to move the markets, who can bring momentum in driving the prices outside the value area. So usually that could be mostly missing. So because of that, markets get into a sideways price action. So why we have to track the sideways price action? Because usually it will be affecting our strategies. Let's say I'm expecting a trend, and all of a sudden sideways market happens. That could be the most annoying thing that every trader can incur, right? So usually it is challenging for a trend followers. So mostly if I'm a trader, I'm expecting a trend and I'm going to incur a sideways markets. So then mostly the trader will get puzzled, at times it will get annoyed, and that may lead to a bad decision. And sideways markets usually happens during the regime of low volatility. So market volatility will keep on dropping. During the sideways markets, the trading opportunities get smaller and smaller. Trending markets, opportunities will be very much bigger. Sideways markets, the opportunities will get smaller and smaller and smaller. Yes, at times as a trader, we may have to trade the smaller opportunities also, particularly if you are a full-time trader out there. It is not always looking for a bigger opportunity every time. So if you are a full-time trader, sometimes you may have to trade the bigger opportunities. Sometimes you may have to learn to trade the smaller opportunities also. So the goal is to find the opportunity, and the goal is to find the opportunity and classify whether it is bigger opportunity or a smaller opportunity. Sideways market means reasonable smaller but very frequent opportunities. Trending market means bigger opportunity